In this episode, we're diving into TGIF, what it is, how it works, and how you can identify and use it in your trading. This is a repeating weekly behavior in the market, and once you learn to spot it, it can help you consistently find high probability trades. So, without wasting any time, let's get into it. So first, if you look at the left side example, what we have is a bullish weekly expansion candle. The candle opens, then price moves below the opening price and forms a low. After forming that low, price expands aggressively to the upside and creates a high. Now the important part here is what happens after the high is formed. From that high, price pulls back down into the closing price. That move from the high down into the close, that little retracement or wick portion, is what we consider a bearish TGIF. Now on the right side, we have the opposite scenario. This is a bearish weekly expansion candle. The candle opens, then price moves above the opening price and forms a high. After that, price expands aggressively to the downside and creates a low. Now again, the key part is what happens after the low is formed. From that low, price pulls back up into the closing price. That move from the low back up into the close, which forms the wick, is what we consider a bullish TGIF. So essentially, TGIF is not the entire candle. It's specifically the move from the extreme of the expansion back into the close. And depending on the direction of that move, it tells you whether it's bullish or bearish TGIF. Once you start identifying this properly on higher time frames like the weekly, it gives you a very strong framework for understanding where price might rebalance or react in the following sessions. To get an even better view of this price action tendency, we can break that single weekly candle down into a daily chart so you can actually see how it forms step by step. So in the bullish example, price opens at the start of the week, then initially drops below that opening price, and forms the low of the week. After that, as we move into the midweek sessions, price begins to expand to the upside and creates a local high. Now the key part happens on Friday. Instead of just holding those highs, price comes back down into that weekly range and returns toward the closing price. That move back into the range is what forms the wick that you see on the weekly candle, and that is essentially your bearish TGIF portion of the move. Now, if we look at the bearish example, it's the exact same concept but flipped. Price opens at the start of the week, then moves above the opening price and forms the high of the week. After that, through the midweek, price expands to the downside and creates the low. And again, the key moment is Friday. Price comes back up into the weekly range instead of staying at the lows, and that return into the range forms the wick on the weekly candle. That move from the low back into the close is what gives you that bullish TGIF. So when you break it down like this, you can clearly see that TGIF is not random. It's a very specific weekly delivery pattern where price expands early in the week and then rebalances back into the range toward the end of the week. Now that you understand the basics of this concept, the next important question is, when does TGIF actually occur? Because one of the biggest misconceptions I see is that traders think this is something that happens every single week, and that is simply not the case, at least not in the form of a high probability setup. If you just look at a weekly chart, you will notice that most candles have wicks on either side, but that does not automatically mean there is a TGIF setup in play. The key difference is understanding the daily fractal inside that weekly candle, because that is what actually tells you whether this is a valid setup or just random price movement. So there are three main criteria that must be met for a TGIF setup to be anticipated. The first thing is where the reversal for the week forms. In a bullish week, the low must be formed on either Monday or Tuesday. In a bearish week, the high must be formed on either Monday or Tuesday. This is very important because if the reversal point for the week forms later, like on Wednesday or Thursday, then Friday becomes a low probability condition for price to return back into the range. The timing of that reversal early in the week is what sets up the entire structure. The second thing is that Once that reversal point is formed, price must expand through Thursday. So in a bullish scenario, after forming the low on Monday or Tuesday, price should continue expanding to the upside into Thursday. And in a bearish scenario, after forming the high on Monday or Tuesday, price should continue expanding to the downside into Thursday. This expansion is what creates the range that Friday will eventually rebalance into. The third and final criteria is that price needs to reach a higher time frame objective. In a bullish expansion week, you want to see price trade into a premium area, and in a bearish expansion week, you want to see price trade into a discount area. This could be a higher time frame PD array, and ideally, you want to be looking at time frames like the 4-hour and above for these objectives. So when all three of these conditions are met, you now have a high probability environment where Friday can deliver that TGIF move, where price comes back into the weekly range. But without these criteria, even if you see wicks on the weekly candle, it doesn't mean a valid TGIF setup is actually in play. Now that you understand the concept of TGIF and when it's likely to occur using the three-step process, we can move into a real chart example and actually apply everything step by step. So going back to the three criteria, the first thing we want to ask ourselves is, what day did price reverse? Looking at this chart, you can clearly see that price formed the low of the week on Tuesday. That satisfies our first condition. Because in a bullish scenario, we want that reversal to happen on either Monday or Tuesday. Now moving on to the second condition, we ask, did price expand through Thursday from that point of reversal? From Tuesday's low, we can see that Wednesday and Thursday both show strong expansion to the upside. There is clear higher time frame displacement and directional order flow, which confirms that price is actively expanding and not just ranging. Now the third and final question is, did price achieve a higher time frame objective? And the answer here is yes. On Thursday, price trades into the external range high, which is a premium array on the higher time frame. That tells us that price has reached an objective where it can begin to rebalance. So now that all three conditions are met, we can reasonably anticipate that Friday will deliver the TGIF move, which means price is likely to return back into the weekly range. Now in terms of targeting this move, we are not expecting a full reversal of the entire weekly range. What we are looking for is a retracement of roughly 20 to 30% back into that range. So what you can do is mark out the low of the week and the high of the week, and then use a Fibonacci tool anchored between those 2 points. From there, you can clearly see where that 20 to 30% retracement lies. And as price begins to trade on Friday, you can watch how it starts to move back into that portion of the range, delivering the TGF setup exactly as anticipated. So that is how you apply the TGIF concept in real market conditions, and not just understand it theoretically. Once you start combining the timing of the weekly reversal, the expansion through the midweek, and the achievement of a higher time frame objective, you'll begin to see that Friday is not random. It's actually delivering a very specific type of price action when all the conditions are met. The key is patience and discipline. You're not looking for this every single week. You're only looking for it when all three criteria align. That's what makes it a high probability setup. And once you start seeing it play out in real time, you'll realize how consistent this behavior actually is when the narrative is correct. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.